Hello.
How you doing?
Good, good. How are you?
I'm good, thank you.
Thanks so much for taking the time to talk with me. Really appreciate it.
Well, it's my pleasure. I hope I add some new dimensions to the current situation.
Oh, I'm sure. We have a lot of people in the room who definitely would love to hear from you. And a lot of the guys in the room, because I've been such a big fan of your books. Over the years that most everybody in the room has your book. We've got about 70 or so people in there. So every single person's read your book. They all love your stuff. So that's always you certainly come up a lot in the room. So it's cool to hear from you.
Well, that's very nice to say. I appreciate you saying thank you. That's good. It's a good thing to hear.
So how are you today?
I'm okay. It's kind of I'm in Dallas, Texas,
Hmm.
and it was cold this morning. It was 70-ish now, so it was a nice day. Although I haven't been out, but it's a nice day. Where
Nice.
Where are you?
I'm in Cleveland, or sorry, Columbus. Moved to Columbus about 5 years ago. I still say Cleveland all the time. Actually, just went to the Keys. Just got back from there. My nose is all burnt up and shit, but it was a phenomenal trip. So I'm very glad to get out of here for a little bit. Definitely looking to move south very soon at some point in the next couple of years.
Is Ohio opened up, or do they still have restrictions?
So we're like in so Ohio is basically like a red state that tries to be a blue state. So they're in the middle of everything all the time. When I went to Florida, everything was open. Nobody gave a shit about anything. And then my girlfriend and I, she's a power lifter. So we went to Texas. And
He's a power lifter, did you say?
yes, yes. So when we were in Texas, we went straight. It was actually funny. It was July, and this is when everybody's freaking out to spike. Oh my God, we're all gonna die. We fly out there. We have this great time. She has this powerlifting event. There's probably 10,000 people there. Nobody was wearing masks. Nobody was cared about anything. Not one person got sick from the whole event, and we went home and everything was great. It's just surprising. How everybody's blown this thing up so big.
I see. Well, look, now, how do you want me to refer to you? Your first name, last name?
Oh, Jason's fine. Yeah, Jason's good.
Okay, fine.
Yeah.
Okay, Jason's good. And now this is going to be approximately an hour. Is that
Yeah,
true?
30
More or
minutes to an hour.
less?
Yeah, 30 minutes to an hour, whenever,
Okay,
whatever time you have.
okay, fine.
Mhm.
So, how many people are going to be on this Zoom call?
Oh, no, nobody's on the Zoom call. I'm just gonna post this in our group when we're
Oh,
done,
okay.
and
So it's
probably
just
to
you and I.
YouTube. Yes, just you and me.
Just,
Yeah,
okay,
yeah.
cool. Good.
So that'd be better than a bunch of people could get confusing.
Okay.
Cool.
All right. So why don't you kick it off then, Jason?
All right,
And
sounds good. The first thing I actually wanted to talk to you about, just because this is directly from you. I use this from you all the time. It's the pursuit of superior returns, and starting off at a certain point, getting to that point, using things like options after a certain point in the year. So I wanted to talk to you a little bit about certain times where you brought up a great story before about options, and you using them too short dated. This is one thing we have a lot of new traders have a lot of trouble with, is taking thinking you can time it so well, but also knowing that sometimes that it's just not going to work out perfectly. So I think your story of that illustrates that better than just about anything I've ever heard. So if you wouldn't mind going kind of through how you came up with that method to create the pursuit of superior returns, and then possibly getting into your option story.
okay, well, those are two different principles per se, meaning the superior returns you achieve by first making consistency, right? And the goal is you don't want to be out of business, right? So
Yeah.
it's preservation of capital, consistency, and then when you've accumulated some profits through consistency, you then can be a little bit more aggressive or a lot more aggressive to pursue your superior returns. But if you try, in other words, if you try to pursue superior returns without some cushion,
Mhm.
and you lose, you can wind up being out of the game. And the key is to always be in the game,
Mhm.
for better or for worse. So the pursuit comes from first saying, well, I'm going to show I can win consistently, and then you'll develop confidence if that's the case. And then you can be much more aggressive in increasing your size to get those superior returns. See, it's just a logical sequence, right?
Mhm. Yes.
Okay. Now, the options, see, again, I have an option. I have a book two. I had a whole chapter on options, and I have lots of option stories, but I'm not sure I know the one you're referring to, the one you're thinking of.
So when you go long the world, you think you actually say this. You went long the
Okay.
world, and basically your the timing for this was a little bit shorter. Your expirations were shorter than the timeline you feel like you
Yeah.
should lose.
I think that, again, this is a learning experience. And
Mhm.
this was in the early 70s, I believe. I mean, again, I have a lot of stories. So this one is vivid in my mind because it was a
Mhm.
big play. But in the 70s, the early 70s, I had my own company, Ragnar Option Corp. And we basically were short. I was short in that period in 71, 72, excuse me, 73 and 74, and did very, very well. And you come into the end of the year, and I was a big Dow theory advocate, which is in the books, and it worked really well in those days, and all the way up until probably the 90s, the early 90s. But in any respect, there was a rally in August, and then the sell off came into, by memory, December. I think it was December the 6th of 74, and there was a divergence, and the volume dried up. Classic, if you know Dow theory, and Robert Ray is the guy I learned it from through his books. And it was a perfect buy, perfect. So on the day of the low, literally the day, which I believe was December the 6th, I think it was, by memory.
Yeah.
So I went along the January calls in size. Again, I had had a cushion. We were short all year. Mainly it was the Nixon issue, that we were in a recession and Nixon was being impeached or going to be impeached. So I really went along, as I said, as I'll repeat, the world. Now, what happened was I remember buying just one position was Eastman Kodak, and which was 80 at the time. And I think the stock was 70 when I bought these 80 January calls. And, I bought hundreds of them, and I bought them across the board. I mean, I owned everything. And sure enough, it took a long time, meaning there was a delay of this huge rally coming up. But I did buy the low. But what happened was those Eastman Kodak calls lapsed at 79-ish, in that range. A week later, they were in the 90s. So it told me that when you're buying options, uh, and you let's say you're right, you need some time. So you can't be perfect. You should not try to be perfect. Now, of course, some people will be perfect by getting inside information. But if you're trading and you're honestly just playing off of indicators, the tape, your sense, you should be buying call options that go out at least 2 months and probably 3. And you'll make a little less. You won't get the same leverage kick if you don't buy as many. I mean, those Eastman Kodaks could have been $100. I don't remember what they cost, and you could have bought the 2 months out for 2.25 or 250, let's say,
Yeah.
you would have made a lot more, would have been a much bigger success. Now, I still had a winning year. Now I'm in January the following year, completely different thing. Of course, it's early in the year, and some of those, mark to market, they didn't get marked down as much. So I still had some mark to market losses. But the key there was I called the low of the 70s, 80s, the rest of this century, and basically I didn't make a lot of money because I didn't buy enough time. So that was a real lesson.
Yeah, that's a phenomenal story, and I know everybody has done it. It's one of those things that you when you start trading, let's be honest, you start to think you know some shit, and the market likes to teach you that you really don't know everything sometimes. And I've done that just like you have, and then listening to your story, I didn't really put it together what I really did wrong the first time I did it. And then listening to your story was really helpful for me. And I know there's a lot of newer traders that, I mean, God, they'll do it a week out, and be like, I can't believe I got this wrong. It's like, exactly what you said. You just want to give yourself that extra bit of time to get it right. And that's going to help you really make that big return.
Right. Right. Timing and options is not a good idea because you really have to be perfectly right or generally right, but you also need to make the velocity of what you're buying in this example move up quickly. And options are really for low risk and to use as leverage. I mean, that's why you buy options, limited risk and leverage. So they're not for timing.
Yeah.
You see, as opposed to, I buy a breakout or something and the market moves up. It's a timing play. It's not a leverage play. It's not a low risk play per se. Well, it is a low risk play, but it's not a leverage play. So if I make a mistake, I lose a little and I go on to the next thing. Options, you're looking to make big money, but you're not looking to make big money per se. Timing things.
Yes.
You're looking to be right.
Yeah, great point. And then the next one I was kind of getting to those is also interesting in the books, and everybody in the room has definitely read the books. But you talk a lot about emotional discipline, and the number one rule. You think of the chapter is called 50 Ways to Lose Money. Trade with a plan and stick to it being rule one. And after my years of trading, and that's nowhere near the amount of years you've been trading, the one thing that you see is that there's many ways to trade, but the one thing that you'll see across all good traders is that discipline factor. So if you could name, you worked with all these traders, and you've also trained traders, and so your insight probably comes a lot from that, I'd assume. So what did you really notice was when would it be a time for a trader to just basically say, I need to hang it up and walk away? Or when was a time where you saw somebody go, you thought maybe they should hang it up, but they actually did turn it around and become disciplined?
Well, let me just preface, if you're going to replay this for your colleagues, it is the hardest thing for most people to do, is to set a plan in advance of what you're going to do under certain conditions and to stick by that plan. That's the hardest thing. And when I train these traders, by memory, there were 39 people, and I trained them all the same way. And you can train them, give them knowledge. So knowledge is really secondary, because if you give people the same knowledge, and only 5 people made money, by the way, and the other ones would blow up, and they'd be effectively mission impossible. They'd be fired.
Yeah.
And you give somebody capital and say, okay, you've got X, and X depends on your experience and who you were. some young traders, maybe it was as low in the 80s as 25,000
Mhm.
trading futures on the floor. And some of the more, let's say, experienced block traders, I'd give them to 50. And you sort of give the more experienced ones a little more, is generally what I did. Not that that mattered, because they could lose just as easily as the younger traders. But the key was that if you want to win in this business, you have to have the discipline to say, okay, I'm buying silver at 22, and I'm going to sell it at 22 and 21 and 3/4. I mean, I'm using an example here.
Yes.
So if you do that, and you do that all the time, and you pre-plan what you're doing, now you'll get whipped some more. Who cares? The key is you're never going to take the big hit if the goal is to be in business, right? Now, there are plenty of people that made fortunes here that you not using those kinds of disciplines.
Yeah.
But the point is, there are many that blew out too, right?
Yes.
I mean, if you bought Bitcoin at 1,000 and you held it, maybe you depending on how many bought, but you probably made millions. The key is, and let's say you had no discipline, you can make money doing that, but as a professional, if it's the way you make a living, the theory is you want to be in business. You can't trade if you're not in business. If you blow out, it's a lot harder to raise money if you've lost all your money.
Yes.
Right? It's a lot harder to go raise money because you've already demonstrated you lost it all.
Yes.
So the key is, once you accumulate it, the key is to be in the game. So that's kind of a basic principle. The emotional discipline is much harder than the knowledge. You can teach people knowledge. The key is they don't follow it. They're too attached to the, I don't want to lose, or it's going to come back, or who cares? Who cares if it comes back? It's a whipsaw. It doesn't mean anything. You're sitting at your desk, you're in the business, and you'll make money the next time around. The next trade, or you'll catch a big event. If I had that, by the way, Warren Buffett made all his money by buying effectively the same price levels. The December lows in the markets, and the Dow at that time was more important than the S&P. And that was lucky. He just went in at the right time. But the key is, he became, one of the richest men in the world by having a plan. Now, I have a lot of criticism of Warren Buffett in some arenas.
Same.
But the thing is, he had a plan. He stuck to the plan. And that is really, the plan works. He's an investor. He believes the market's going to take him out. The politician, he doesn't say this, but politicians save the day. The Fed saves the day.
Yeah.
So, but he had a plan. So you have to have a plan. You have to stick to the plan.
Great. That was wonderful. Well said. Well said. And there was one part in it might have been New Market Wizards, where you talk about hiring people with PhDs and stuff to trade, and I think you talk about the fact that they think so highly of themselves that it's hard to be a trader and just stick to your plan and say, well, I'm wrong, and get out sometimes. I don't want to say the names of these people, but it was an interesting one that happened to me not too long ago, which was two PhDs trying to charge a car. One guy's a surgeon, and they're both sitting there on the side of the road, and they want to charge a car. They bring the one car over. They decide that red must go to black. And I went to automotive school. And automotive school, we went through tons and tons of kids who, the first day we'd come in, that's what we'd all do. And so going through all these kids, never one of them ever did that. ends up hooking it up. He blows up his battery. It's just hilarious because it just sometimes they make it so overcomplicated. So it's really, that was a very interesting thing you brought up that was in New Market Wizards, just to kind of add to that.
Well, just to embellish on that story just a tad, the point is usually these very bright people, IQ wise. My assistant who just left, who's been with me since the 70s, he's got a genius IQ, but he can't make a dime trading. Now, the reason is if you ask this guy anything, he knows the answer. Whatever it is, you can ask him because he reads and he's got a photographic memories per se. So these PhDs, using them as, high IQ, very learned people, they are right so often about so many things that they develop a very high self-esteem of themselves, which is fine. That's a good thing. But in trading, you could go and you can do research and spend months. Let's say I'm going to use an example in the automotive business. You think, there's a recovery coming, the car companies are going to come back. There's going to be, a whole new buying spree of automobiles. So you go through this and you spend 2 months as a researcher doing this. And you've got this, you're a fundamental driver, like a Warren Buffett type. And you come to this conclusion, you go long. So now here you are long the auto stocks you've researched, and you're sure as rain that this is going to happen. Now and here comes the point, something has changed. Something somewhere in the world has changed, but you don't know that change because you can't know everything that's going on in the world that's hidden from you. So all of a sudden the markets go the other way. And if you don't have a strategy to exit, which most of the people don't, they spend 2 months saying, okay, I've researched this, I know this is going to happen. They don't have let's say the emotional discipline to say, whatever I did, I was wrong, or in this example, which is mostly the case, something changed, but you don't know it's changed. So you hang on to that position. Tiger did this, the Tiger funds.
Yes.
I think he bought US Airlines, if I wasn't mistaken. I think it was an airline. It was an airline. He got murdered in it. And he had it from like 80 down to 20 or 15. You see, something changed. That's why I say you have to have some methodology.
Yes.
Basically says, I buy here. The reason is not even as important. Okay. You've come to a conclusion, but where are you wrong to not put you out of business? Absolutely. That's the critical answer.
Absolutely. And that kind of leads me to the next one, which is something I talk about a lot, which is, probably 5 years ago, I stopped really, and you talked about it in your book, and I didn't even get it at the time, which is it's a chapter called How Important Can Anchovies Be? And where you talk about the fact that there's all these very interesting analysts and they say all these very important, wise things, but you don't pay any attention to it. And I was wondering, if you could elaborate on that a little bit for everybody out here, because that's such an interesting point. And to me, I completely agree, but I know a lot of people think I'm just kind of crazy for thinking that way, because that's where they get all their information. They're going to put on trades based on that. And I don't think that it works that way for me either. So I was wondering, what was your point
well,
on that?
What was the point of the anchovy story?
Yes. Just to go over it a little bit.
Okay. Well, the point there is the Japanese buy, or they use anchovies to feed their animals, their livestock, etc.
Yeah.
So the point was that if the tide changes And these anchovy, they swim in huge, monstrous packs, fish, and they get dragged out into the Pacific. This is off Chile. Well, what do? They got to feed their livestock, so they go buy soybeans. So if the tide changes, which you're really not going to know per se, maybe if you could hire people to tell you that, but I mean, nobody thinks that way.
Yeah.
So all of a sudden, they don't catch enough anchovies. They've missed that catch because the tide changes. So they go buy soybeans. Now, the point is that if you knew the tide change, you go buy soybeans, right? So you'd have a great trade in soybeans because of a shift in the tide in the Pacific Ocean off Chile. I mean, you see, there's a lot of information. My point about that story, if I'm not mistaken, is that there are many things you will not know, and you could not know. So that refers back to the last point I made about these intelligent people. They can't know what's going on everywhere in the world. Something changed. They don't know it. That's why you have to have an exit plan.
Yes, always. And then this one's probably I know the guys in the room would kick me if I didn't ask you this one. I'm sure it's been beat to death a little bit, but your Barron's call, brilliant, getting the crash right in '87, also the mini crash in '89. And I was wondering, if you could elaborate a bit on that, because I use a lot of Dow theory. You use a lot of Dow theory. And what was the Dow theory chart telling you in '87 that really kind of made your mind made up? And then also you kind of stepped on the gas at a certain point. So if you could kind of go over that story a little bit.
Well, in that case, in '87, the markets had risen to almost like valuations, not like today, but close. In other words, the market got overbought, it got overvalued. And there were many subtleties to that trade. But firstly, I had made money throughout the year. So I was up. And the market was, hold on. Are you there, Jason?
Yeah.
Okay. I got an incoming call. I hit the end button, but I hope I didn't cut you off.
Okay. Oh, no, you're fine. No worries.
So anyway, so I was looking for a top. Now Greenspan comes in, and fundamentally he's starting to raise rates. Now, if you did that today, the world would collapse overnight because everybody knew what raising rates meant. In the earlier day, in the 70s, nobody even knew what the Fed funds rate was. They didn't know. In the 80s, they were starting to understand that interest rates drove the market to a large degree. So there weren't as many people versed in what interest rates meant. So then you get to the setup in Dow theory where you had a higher high. I can't remember the circumstances exactly, but there was always this divergence. And then there's a sell-off, which happened on a Friday because Monday was the crash. And it broke through the lows. Now, I was already short. I added some shorts through puts. And then, by the way, then I got lucky because the real event that killed the market, and again, see, this is an unknown event, and this people should relate to what's going on today, is it's going to be one of these events. James Baker III didn't want, they wanted Europe to raise interest rates.
Yeah.
So we were coming into the '88 election. He basically threatened over that weekend that if they didn't raise rates, he was going to effectively, the words he used was let the dollar slide. That's an exact quote, which means devaluation. He didn't say how much. That's what really killed the market. But the setup was you had this overbought market, which like you have now.
Yes.
You had rising interest rates, which you don't have now, and the Fed said they're not going to do it. I believe they won't raise rates, but long rates are going up, and that has a slightly negative point. But the key was there was a bit of luck to it when James Baker threatened to devalue the dollar. He didn't say it that way. He said, let the dollar slide if the Germany didn't raise rates. And that's what crushed the markets. See, so you had a number of issues that were occurring at that time. Part of it was luck. Although I think I would have seen the late Friday sell-off. That was before Baker talked. So the key was the market was set up to sell off anyway. And I would have been right, not to the degree I was. I actually shorted the opening. I rarely do this, but the Monday opening, when I heard what he said, now again, I highly suggest that your traders use fundamentals as well as they do technicals.
Yes,
some people weigh one or the other, but the key was that when I knew when he said that, that the market was gonna take a big hit. So I shorted the S&P. These were the not the mini futures. These were the original futures. $500 a point. And I shorted 5 of them, just 5, because I was already short, and I shorted down 15 handles, and I made $250,000 on that trade, just because I understood the fundamentals.
Yes.
You see, so what paid me on that piece of the puzzle was knowing what it means if you're going to devalue the dollar suddenly, which is what Baker was suggesting. So, if I had to now, let's say, give some advice here.
Please do.
The key is everybody is watching the Fed. Okay, and the Fed is really turned into something that Alan Greenspan should be really criticized for in teaching these people how to overuse the wizard's wands, but the key is everyone should pay much more attention to politics around the world, because politics are going to determine Fed actions. So the primary is not the Fed anymore. You know what they're going to do. They tell you, everybody knows, everybody's following the Fed. It's going to come from the political end. And I would say, to try to stress, just like that example, really what made me the money was knowing what it meant when James Baker said, I'm going to let the dollar slide. That's made me 250. Now I made a lot more money. Strangely, I had, these 39 traders. Again, I've been bearish. I told them that. They read that Barron's article.
Yeah.
Half of them lost money. So barely I made money as a firm, and I knew friends that got blown away. So I was happy. But I should have made 10 times the money I made. But you see, these traders did not follow the knowledge. They didn't follow the knowledge, and they didn't follow the disciplines. So, it was not a great business the way it was set up. But anyway, the point is, you must follow politics under these conditions, because what's going to happen if you look at history, and I'm going to give you one other example, just to make it concrete. In the 60s, and I was watching the markets. I wasn't trading. This is 1962. And Kennedy was president. And he basically, the steel companies are raising prices. He basically attacks the steel companies for raising prices, which in that day looked like socialism in the minds of the people of that day.
Yeah.
The market dropped 26% because he interfered with the markets on steel prices. See, that was an unknown thing.
Yeah.
It really was not something somebody would have let's say, made a call on that,
Mm.
he's going to say that steel companies shouldn't raise prices. It was the key there was it was interfering in the marketplace. And the market looked at it as socialism, the beginning of socialism. So it tanked 26% in 2 months.
Wow. Yeah,
Just
that's
the
go ahead.
No, I was just saying, just as a oddball example of why you got to expect the unexpected, and it's going to come from politics. Somebody is going to do something or say something, and it's going to affect the markets. Now, what it is, I don't know.
No, that's a great point. And, I think that's one thing a lot of people don't pay as much attention to, especially now. Everybody, especially right now, like you said, it's this whole, oh my God, watch the Fed. The Fed's going to do this tomorrow. Yield curve control the tomorrow. Everything's going to happen. And as I know, is that most likely they're going to warn about it first. They're going to talk about it a little bit. It's not going to, they don't like to surprise the markets. So,
Right.
what you're saying is paying more attention to the outside forces, the unknowns, will probably be where one of these come from. Very interesting. Great point there. And so getting
Yeah,
into, go ahead.
and anything the Fed does that's subtle, and I'm going to be very honest, this was a critical thing, and I missed it at the time when the Fed was paying interest on reserves.
Mhm.
They were supposed to start this in 211. They started in October of 208. And basically it was, we're going to put a lot of money in the system, and paying money on reserves was paying banks not to loan the money. That's why there's no inflation.
Yes.
And that's why the velocity of money is at 60-year lows and dropping like it's going off a cliff. So the subtleties are to know the rules. And the rules are critical when it comes to the Fed. You got to look into them. Now, I didn't know exactly what that meant. It didn't seem important at the time, but it was critically important. Because I'm in the commodity business. Without inflation, I don't make any money.
Yeah.
Right? So it's important to study these rules and to read a lot.
And speaking about inflation and commodities, so that for me this last year, based in 2020, we kind of saw the biggest deflationary shock we've seen in a long time. You got bonds had a blow off top on March 9th. You got oil going negative, the front month contract. And basically ever since, commodities have finally really caught their footing. And I'm a big bull on the commodity market at the moment. I know that there's going to be all types of structural errors in between, but we'll see what happens. I was just wondering, what are your thoughts? Why commodities finally are starting to perk up, given that the environment is the way it is right now?
Well, it is obviously the increase in the money supply and the Fed spending, the government spending, and fiscal policy,
Mm-hmm.
and the assumptions of inflation, and there will be inflation. And the key is that there's also going to be a slight offset to inflation numbers because they rig those numbers, the CPI.
Absolutely.
And then they also, you've got this mortgage and rental issue where they suspended that. So there's going to be an offset, which is deflation in that arena once they say, okay, now you got to start to pay, and there'll be lawsuits and a lot of people will default. I mean, you go down New York, Madison Avenue, those rents are $400,000 a year, and those stores are boarded up. They're never paying that rent ever. So there's going to be a lot of deflation through the mortgage market, through malls and stores that are closing and things like that. And then people are going to default on their mortgages and loans. And, it's a bit of an offset, but commodities are definitely going up in general. And probably the best cheapest buy, and now I have positions here, so I'm talking my book,
Mhm.
just for the full disclosure, is gold and silver are really the cheapest things you could buy today. You could throw in platinum, but I mean, I'd rather do gold and silver.
Mhm.
And so to me, that's where one should look. Commodities and primarily gold and silver. If you look at lumber,
Mhm.
classic case, shortages, people buying residential housing, commercial, no, residential housing, yes, they move out of the cities. So they're buying and building houses in the country, et cetera. And there's a shortage of lumber, which anybody could have figured it out if you looked, if you were aware, but then you had to go buy the lumber futures. You see what
Yes.
I mean?
Yeah.
And that's why I say you got to look to commodities, because the lumber futures are up from 200 to 1,000. See what I got on my machine here, my memory, but it was pretty substantial, and a lot of money could have been made. And well, let's call it 400 to 1326
Yes.
from October.
It's
It's you.
phenomenal, just
Yeah.
crazy. Yeah, and actually, I myself at least, I put out everybody in the room knows my book, but I have a lumber trade on. Have had two lumber trades this one in 2020 and one this year, and I would have never dreamed in a million years where it ended up. But man, happy with it. But you're absolutely right. It's the commodities market is really and that's another thing I've been talking about a lot is, a lot of people kind of shy away from futures. And I really think that, the next 10 years, it's something that people really kind of need to understand if you are a serious trader. Granted, there's leverage, you can get blown out, you got to be real strict on your risk control and stuff, but you really want to be able to look at those markets, buy those markets, because there's a lot of opportunities in the commodity space. And besides the commodity space, are you seeing any opportunities in the markets, which is kind of almost funny because there's always an opportunity, but it's getting a little frothy at the moment.
Yeah.
I love gold and gold miners right now, but besides those,
Yeah. The stock market generally is so overpriced. I mean, I see numbers in the 40s PE.
yeah.
So I just don't. You can't short it
Hmm.
because it's a runaway train, but the value is not there. See, I could buy silver and gold and forget about it. I
Yes.
don't need to worry. It's an investment concept. And I believe silver will be 50 this year and gold will be 23 to 2400. And so that's my mentality, right? So that's the way I think. And by the way, before I forget, Jason, if you
Mhm.
send me, and I probably have it, but I'm just repeating it, send me your email, because I just wrote a piece on gold versus Bitcoin.
Oh,
And
beautiful.
I wrote it on Sunday. It came out. I write through this guy called the curmudgeon.
Hmm.
If you look, when you see it, you'll have many pieces written in there.
Oh,
Because
cool.
when I want to write something, he's a great editor,
Hmm.
and he's had this since the 90s. And he basically prints anything I say. Now he edits it a bit, and I really don't care as long as he sticks within the topic. In this case, he did,
Hmm.
but I'll send it to you because it is an interesting piece.
Beautiful. Yeah, I'd love to see that. That's one we're kind of where we're at right now is we're kind of in that home run mode type of situation at the moment. And now I'm putting on certain trades, which is it's all gold because basically all I'm seeing is the same thing is right now you have gold miners, silver, gold at this great zone at the moment. Uh, Fundamentally, technically, any way you look at it, it's a beautiful buy right now, especially while everybody's kind of running into this whole Bitcoin is taking over the world type of scenario, which isn't true. But that's how markets are. Falsehoods and lies, as you've quoted before.
Yeah,
Um,
yeah.
so last question is basically, you speak very eloquently, and if anybody hasn't seen this, make sure to check out your views on hyperinflation. You have video on that.
Right.
Moving towards, we have all, obviously, like you're saying, we're going to have these ebbs and flows, but over the long term, do you still see the hyperinflation scenario playing out?
Yeah, I'm going to give you a definite clue. I've sort of written an update now. When I first did that piece,
Mm-hmm.
I basically said hyperinflation a statistical inevitability. I never called when,
Yes.
because that is a psychological process.
Yes, it's possible to
I
do.
only know that the end game from the government is hyperinflation. If you had hyperinflation, which is defined by this guy Phil Kagan as 50% a month, is hyperinflation. CPI 50% a month. 4 months, you'd knock off 94% of the debt. 4
Yes.
months. So they can't default. They're never going to default. So anybody that thinks bankruptcy, that just have no concept of how governments work. They wouldn't let long-term capital default. I mean, they're not going to let the default.
No,
The
nothing.
key is
Yeah.
the end game is hyperinflation. Okay, because it's quick. Like I say, 4 months. Anybody can live through 4 months of anything, right?
Yes.
So they'll wipe out. I mean, it'll be a disaster for a lot of people, but that's the end game. Now, when does that happen? I've filtered this down a bit to when modern monetary theory kicks in. It's all over Biden's plan. Stephanie Kelton has, she's all over their manifesto for the Democratic platform.
Yes.
And so when they give you 1,000 to 2,000 a month to the bulk of the nation under 18, which is about 270 million people-ish, you'll get your hyperinflation. The reason you haven't gotten it is because if you give money to Bill Gates, what difference does it make? He'll just buy another company or invest it somewhere. He's not going to go out and spend it. You get hyperinflation through the turnover of money, through velocity, because people are spending it because they don't want the currency. But if you own stocks, if you look at Venezuela, they should do okay. And therefore, when you give money through QE, which is where a great deal of the money supply growth came from, and you get no inflation, it's because you're giving it to the people who don't spend the money, they invest the money. So where's the inflation per se, or the price increases come from? From inflation. The inflation is printing the money. The price increases are the result. They go into housing and the stock market. That's basically where it went.
Beautifully
so
said.
Hyperinflation will come when they give it to the people.
And that's kind of already started a little bit, and it's
right.
We're moving that direction, and I completely agree with that thought. And I know a lot of people, they're on the fence about it, but it's like, we've kind of, to me, we've seen that almost psychological shift where, not that I'll never know the exact timing, of course, but we kind of are seeing that psychological shift where we are starting to see that inflation coming in. People, once again, everybody's still not admitting it's happening. Commodities are going to fall apart any day now, is what they're all saying. But it's very interesting, and yeah, once again, I would like people to definitely check out your thing on hyperinflation. That was really good. So thank you so much for your time. We always ask one more question, which is, if you were to give any advice to some of the younger, newer traders in the group, what would you say to them?
Well, the basics are pay more attention to the technicals at this point, because they're more honest. If you buy at 50 and you sell at 49, you can lose $100. You've got your system set where you can't go out of business.
Yep.
But you've got to learn more about what fiscal policies are going to do to the future of the U.S. That's where I think people, they look at the Fed, but like a magician, is telling you, look at my right hand, and the left hand is what counts. So I'm only saying that you study the fundamentals of government and the history of governments, but pay most attention to the technicals, because they're going to keep you in business. Don't worry about the whipsaws. Okay. That would be my advice to new people.
Great. That was spot on. Wonderful. Thank you so much. You've been a big inspiration for me over all these years of trading. It's been a blast to get to talk to you for a bit. Thank you so much for all the great advice. And
Well, a pleasure to meet you, Jason. What's your last name?
Perz, Perz.
Perz, right? I got in the email. Yeah, do it. Send me an email again. I know I have it, but just so I will send you this piece on. I'll send you the last two things I wrote up in the last couple of weeks, because they're very interesting. I think I've gotten a lot of feedback. So usually if I get good feedback, I think it's good.
Awesome.
Feedback, it's not good. But anyway, look, a pleasure to meet you and good luck to you. And yes, you should move to Florida only because of the taxes.
That's a big part of it.
That's why I moved to Texas.
Yep.
In 94 was the taxes and the women are great down here.
It's a lot better than up north, I'll tell you that much.
Absolutely. Absolutely.
All right.
Okay.
Victor
And if there's
Sperandeo.
anything, here's an offering for you. If there's anything that, now I don't have all the answers. Okay. I only know what I know is what is basically the way saying goes. But if you have any questions on something, you can always shoot me an email and I'll answer you.
Oh, much appreciated. And I really appreciate that. That means the world to me. Thank you so much. I can't thank you enough for doing this, and that offer is great. I'll link your two letters also into the YouTube for this as well.
Okay, great. All right. So have a good afternoon and a pleasure to meet you, Jason. Thank you for all the compliments.
Oh, thank you. You take it easy.
You too.